All right, welcome everybody, and thank you for taking the time out of your busy day. Happy day after Fed rate cut day. We did get our 25 bips cut. No guarantees from the chair that we'd get one in December. Looks like the futures are back up to looking like we might get one. That should bounce around for a while. Kind of shocked that, or not shocked, but I guess sarcastically shocked that the market was expecting a guarantee from the Fed chair. QT's ending, that's pretty good. Maybe the market's a little spoiled here, a little overbought. We are seeing some October phobia. Think that's going to wind up pretty soon. And some takeaways, though. The shutdown didn't seem to be concerning the chair, and also not about the data coming through. He mentioned initial claims, which is one of the jobs labor market metrics we always like because it's hard to manipulate. So claims are going up, openings not going down, maybe a little cooling. His comments about the AI boom also not being like the .com boom valuations was encouraging, and the fact that he didn't feel the data center build out would be impacted by 25 basis points. Perhaps he was taking a little bit of a victory lap, maybe taking a little dig at the administration. Either way, pretty good. I know the market's a little disappointed with some of the Mag 7 numbers after close yesterday, and the punch bowl not being guaranteed for another cut. So our 26th Almanac is out, the 59th annual edition, out early this year. Our Almanac Investor Newsletter subscribers already have their copies. October phobia continues to spook the market and volatility and check out volatility. But as Almanac investors know, this is very prototypical market behavior, and this is what sets up that year-end rally. And it's right in line with our, seasonal analysis and fundamental and technical analysis. And that's kind of why, part of the reason why we expect a Q4 rally, a monster rally, and 7,100 by year end. We're looking at the best case scenario from our annual forecast that came out late last year, December 19th of 24. We put that out every year for the newsletter just before Christmas. Next year's a different story. You can read about it in the 2026 Stock Traders Almanac in my outlook on pages 10 of 11. We are bullish for the prospects of the market right now over the next several months and more new highs, but next year's a different story. So just a little history. We've been on the street for 60 years. My illustrious father, whose birthday I celebrate, would have been his 102nd birthday, I celebrated online on the feed the other day. Here's the first edition, the 68. Basically, I was born, bred, weaned, raised on market cycles, trends, and patterns. His book from the 80s, Don't Sell Stocks on Monday, my Super Boom book, which is based upon a forecast that he made in 76 for a 500% move in the market, which transpired, was down 34.20 back then. We've already eclipsed that. It's ahead of schedule. I'll update on that a little bit as well. Some of the other places we get to see, my little book of market cycles, stock market cycles, which still seems to have some legs. Again, we lost the man, Yale Hirsch, back in 21 at the ripe old age of 98. But his legacy lives on. And, it was a hit coming out of the blocks, but it's been continued to receive very well. Been on the desk of top traders and managers for the last 7 decades. Some people think it's the most influential book on Wall Street. We've sold over 1.5 million copies. Yale created the Santa Claus Rally, the January barometer, the best 6-month strategy. He put the 4-year cycle on the map. He invented the phrase, if Santa Claus should fail to call, bears may come to Broad and Wall. That is, I guess, part of why we're all here today. And then, I like to say, forget sell in May. You got to buy in October and get your portfolio sober, or get yourself sober. So my philosophy is sort of a takeoff on the old Santana quote that those who fail to remember the past are condemned to repeat it. I like to think that those who understand market history are bound to profit from it. And that's all part of our process where we have been researching and analyzing every trend imaginable for the past 60 years. We publish it annually in the Almanac, update it weekly and monthly in our Almanac investor newsletter. We use all this information and knowledge, try to turn it into wisdom to construct portfolios using seasonality, cycles and history, technicals and fundamental analysis, market internals and sentiment, monetary and geopolitics, as well as current trends and the economy. Quite a trend going on right now with this AI boom. Pretty impressive. So just a little shout out to the service. You know, if you want to join up now, you get a free copy of the Stock Traders Almanac. You can hit this QR code, use this promo code to get savings. It's only $179 for a year, $299 for 2 years. That's our best deal. All subscriptions include an annual Almanac. So just while you're listening along, you can go ahead and check it out on your phone or on your other screen or whatever you want to do there. So today's takeaways. We're going to get into the real Santa Claus Rally, some of the other year-end seasonal trading patterns and strategies, an indicator roundup about the talk about the monster Q4 rally that's underway, even though we're in a little soft patch here at the end of October, 7,100 by year end, how October phobia sets up the Q4 rally in the best 3 months, our best case scenario pointing towards a 20% gain, the most bullish post-election year pattern out there. We've had the best worst 6 months. We still got a day left, but looks like the best worst 6 months since 1950 indicates no losses in Q4. We think that shutdown likely ends after Election Day. Maybe some people looking for a little bit of a surprise. Maybe they will be surprised by what they least expect, and that at least after the election, Congress will have few excuses to get back to work and get this thing settled and have both sides come to some type of agreement, some middle ground. Nobody wants to go into Thanksgiving with the government shut. So we've got some bullish sentiment pretty high up there. The market tends to climb that wall of worry, and we're going to look at some of the AI instead of bubble mechanics, super boom mechanics, and some year-end crypto seasonality trades. So basically, we've been hearing lots of calls and discussions about the top. I have some feeds that I track, you know, old school listserv stuff where technicians and everyone's looking for the top, talking about here Hindenburg omens and all kinds of things out there. A little bit of selling, you know, this month today, but all in all, we've only had a 3.2% intraday pullback, maybe testing a little bit of that today, but not much. So our bullish forecast on track back in late 24, as I said, December 19th was that issue. We put out our base case, best case, and worst case scenario. We've taken the worst case off the table. Clearly, it's been off for a long time. The best case with the S&P up, you know, about 17% until, you know, as of yesterday's close, very close to that 20% gain. Probably still maybe even higher than 70% probability now. Still looking for this Q4 rally in November, right around the corner. Best month for the Dow and the S&P. I think this is a pause, another pause that refreshes, another buy the dip moment. So again, October, this never gets old for me. This is a picture of the 1969 page in the Stock Traders Almanac, page 89. We've been experiencing October phobia since as long as the book's been, you know, we've been publishing, as long as we've been in business, 60 years now. It's the same as it ever was. Some things have changed, but this has not. Portfolio managers tend to come back after Labor Day and clean house in September, end of Q3, preparation for December 31st, year-end window dressing, and portfolio restructuring. But much of this is driven by the October 31st mutual fund 40 Act fund deadline, where managers have to reconcile accounting for year-end December 31 distributions to shareholders, and they have to reconcile the previous 10 months with the current 10 months and the full calendar performance. And this is what creates this seasonal vortex in September, October. We're experiencing that right now. And that's what makes October the best month to buy stocks, especially small caps and tech. October is a bear killer, the bargain month. And again, first featured in the 1969 Stock Traders Almanac. And, you know, some of this mild perennial October phobia we're experiencing is setting up the market for this Q4 rally. The most bullish pattern that we're looking at here, the post-election years since 85. The green line, let's see, put on the laser here. This has been the best year of the 4-year cycle, the first year, the post-election year since 1985. S&P's up about 18% in these years. Dow is about 17%. So we're back on track. Yeah, we're off a little bit here towards the end of October, but we're, you know, above even the most bullish line, which is why we're looking at 20%, pretty much high probability, over 70%, maybe more right now. And the fact that we came so far below with the tariff tumble back in April, maybe we will in turn be quite a bit above these patterns here. So again, this aggregate cycle is combination of all years since 1950 or 1949, all post-election years, and all years ending in 5, that middle year of the decade, that decennial cycle year, that's pretty strong. And then a black line is all post-election years, and this is what has us expecting a monster Q4 rally and S&P 7100 by year end. So another thing, I mean, there's new highs in September, new highs in October, new all-time highs, very bullish. We've seen the 9-month gains, the 10-month gains, all indicating further gains here. But the way we look at it is that we've had this worst 6 months period being the best. So when seasonality doesn't transpire, it's a sign that more powerful forces, more powerful bullish forces are at play, and it's an indication that we'll see more of that moving forward. So as of the close yesterday, October was up 3% for the S&P, 23.7% for the worst 6 months. That's the May through October period, the sell and May period, starting from April 30th to October 31st, which is tomorrow. So the best worst 6 months since 1950. No losses in Q4, no losses for the year. A couple of the subsequent best 6 months had a little bit of trouble, but still better than average, up 80% of the time, average gains, you know, 9.5+%. Q4, 6% gains, full year, 23% gains. I mean, these are the things that stand out to us. So a great, one of the best worst 6 months since 1950 is a bullish indication, and especially for no losses in Q4. So the November Almanac here, this is the best month for the Dow and S&P, number 2 for NASDAQ. We've also got the post-election year rankings, a little bit, you know, down in the rank, not much, but still strong gains, strong upside plurality of gains there. And interesting to me here is that, you know, the dotted lines here are the post-election years, and the solid lines are the most recent 21-year period. We like to compare different time frames, and sometimes these patterns, you know, are different in the year of the 4-year cycle. But here, the combination is just straight kind of up. There's a little dip here around Thanksgiving time. We've seen some weakness come in there. So November, very bullish. The first 6 days for the S&P, cluster of bullish days in a row. That's days that are up more than 60% of the time in the last 21 years. We've got a Halloween trade in play right now that plays off of that beginning of November being very strong. So, you know, it's hard to argue with history on both sides here. So in addition to November itself being pretty rather bullish, extremely bullish, it's the beginning of the best 3-month span, where we see cash inflows from institutions driving November higher, and December and January. You can see NASDAQ up 6.2% for the 3-month span, S&P and Dow 4.4%. Again, best 6 months, best 8 months for NASDAQ, best 3 months. This all starts next week. So perhaps even, aside from the other bullish factors, we might get the end of the shutdown after Election Day. So we had our seasonal MACD buy signal. It got a little red against us after the rare earths China tariff issue on the 10th, but we had our positive crossover here. This is the 817.9. So MACD, I'm assuming people, maybe I shouldn't assume, but I know a lot of people know what it is. Moving average convergence divergence, invented by the late great Jerry Appel, where you took a combination of exponential moving averages and exponential moving averages, a moving average that puts more weight on the most recent data point. For the buy side, we use the 817.9. Sell side, we still use the slower, longer MACD, the 1226.9, the traditional one. There's lots of different iterations of it. This is on the daily as well. So, bottoms being more of a process, we look for the more of an event. Tops being more of a process, we look for at the shorter MACD. And once we get into October, the last month of the worst months, we look for a crossover. We had one on the 6th, dipped a little below, bounced right off of the 50-day, and this was a chart from earlier today. We're sort of just down a little bit. Again, today's screen might look a bit red, but looking at this chart, it just looks like a little bit of a pause and consolidation. So October's pretty strong so far. Little chop here and there, a little October phobia, but technically it looks like we busted out to new highs over there. So the best 6 months history. This is the case for buying October and get your portfolio of silver. The best 6 months switching strategy has been around since 1986, when Miguel Hirsch first published it in the 87 Almanac. Fast forward to 2025, and it's still the best black box system out there. As I showed you with the MACD, and I'll show you in a second here, that's even stronger with that. S&P average is about 7%, advanced 77% of the time. Dow's even stronger, 7.4. We did give a little back this year, but nothing's perfect. Nothing works 100% of the time. And this works a lot of times. So people will go back to the beginning of the data set and say that the sell in May, or the best 6 months is irrelevant, because they keep this period from 1901 to 1949 in there. Now I've just compared these different time frames here. Back in the first half of the last century, America, when the economy was a farming economy, it was an agrarian driven economy, where in the spring there'd be a lot of buying of seed and fertilizer and fuel and hiring and borrowing of money, and then when harvest time came around, the loans were due, the market would sell off. Now we see 1950 through 2004, and then I put 88 through 2024, here, because that was right after the 87 crash, when they put in the collars and the circuit breakers. So we sort of changed it, but you see the same pattern here. And it's not sell in May and go away. It's a reposition in May. It's sideways. So you can see that most of the market's gains are made here from late October, which we're seeing right now. This little sell-off here, through May and even into June, July. Mid-July has been a great sell time. That's where we sell, where we've got a couple of great MACD sell signals for the NASDAQ best 8 months. So back in 2008, there was a book that came out by David Aronson, a technical analyst. He's a CMT guy. It was called Evidence-Based Technical Analysis. And he took 6,200 plus different black box systems, put them through the scientific method, disproving the trying to disprove the null hypothesis, basically assuming that the results of any of these systems were the result of chance and had no predictive power. They all failed. We asked him to take our simple best 6 months, buying on October 31st, selling April 30th versus April 30th and selling on October 31st. He went back to 87, the first full year after we released the strategy back in 86, and found that unlike all of the others, this was proven to have predictive power and not be the result of chance, excuse me. So using our MACD timing, this is just on the Dow, it improves the 7.4% to 8.7. The little gain in the worst 6 months becomes a little loss, and the compounding, the power of compounding, an initial $10,000 investment back in 1950 triples the results to nearly triples the results to about $3,700,000 in change gain versus a loss of about 5,000. So pretty solid. We're in it. I use it. I do it with my own portfolio. On the NASDAQ side, this is using the best 8 months, November to June, and we start looking for the sell signal MACD crossover in on or after June 1st. 12.9% gain in the best 8 months versus a 0.4 loss. Again, since 71, that 10,000 compounds to almost $3.5 million. Again, a loss about 5,000. So great timing this year. We had our sell signal for NASDAQ about, I think it was July 14th, if memory serves. You can check that over at stocktradersalmanac.com if you want to go look back at that. So that's the best 6 month switching strategy. And I'm going to change gears a little bit and go into this graphic that's been circulating around right here. This one about the bubble mechanics of all this concentration, in the economy and everything, being too focused on A and not enough broadening. Well, I'm not sure I actually agree with that. My research in the Super Boom book shows that there are these culturally enabling paradigm shifting technologies that change the world, change people's lives collectively and individually, like the microprocessor and all the different related industries and companies that came into that. Same thing with the internet, the software boom in the 90s, early 90s, and the combustion engine and indoor plumbing back in the old days. So we think there's still more to come. When we put out the Super Boom forecast, I have a projection chart that I didn't add to this deck, but it's available if anyone's interested, where in May of 2010, we put out a forecast with the Dow around 10,000. We put out this projection for Dow 38,820 by the year 2025, based upon the 500% moves that my father discovered with this cycle of war and inflation. And we added the technology to it because that's what we found, was the real, catalyst. Some functional government, like Reagan and Tip O'Neill or Clinton and Gingrich back in the old days, where they compromise and get some things done, does help. But we've upped our target since we first put this out because we feel that the 2011 bottom was probably the end of that secular bear market. And then we broke out shortly thereafter, 2013 to new highs. That was the sort of 1982 moment. And we've upped it to 62,430 within about 5 years. That's an 8.5% annual return. And that's the long game. Again, as I alluded to earlier, I'm concerned about next year. The next few months, I think we got more upside, a little break next year, and then this boom continues again. So we think it's AI super boom mechanics, not bubble mechanics. So some of the things that we look at other than just seasonality, fundamentals, corporate and economic, technicals, as I've mentioned some already. monetary policy and government policy, as well as sentiment and internals. So, you know, some mixed economic readings. I know Chair Powell was pretty bullish on the economy. I know they're looking for some more numbers, but the Fed still got us at 3.9% as of their October 27 estimation. I know there was a little comment about the year's GDP being down from last year because of the dip in Q1. That's going to happen, but I'll take 3.9 right now for Q2 and again for Q3. So there's still some issues with the government shutdown, but as I said, I imagine after the election they'll begin to get things opened up again, and some of the tariff concerns seem to be alleviated with the recent trip to Asia. Again, a lot of that is pomp and circumstance, but it seems to be on the positive side. Things are calm in the Middle East. Russia, Ukraine still an issue, but you know, that's just some of the volatility that we're dealing with right now. Inflation still on the uptick. Not a lot of data coming in during the shutdown. We did have the CPI ticked up here at around 3.1% or so. This is actually the average that I've calculated of the CPI going back into the 40s. So I'm not sure where this 2% target lies, if that's just wishful thinking. We got, you know, close to it on the PCE, even the CPI, but maybe they hit that target. Maybe that's part of the victory lap. But you know, inflation's on the uptick a little bit, but it's not out of control. Labor market, there's been you know, some concerns about it. There's an impact from immigration being down. We've always preferred the claims number, and this is not seasonally adjusted. It was refreshing to hear Powell mention it by name. It's one of the metrics that's not easily manipulated and not adjusted here. It's kind of raw and granular. We did a whole chapter in the Super Boom book on the manipulation and changing of the inflation data to suit the agenda and mask it. You know, maybe if you take the L out of BLS, you might get a little smile. So this is, you know, the concern of the Fed and everybody right now, that labor's employment softening, and that's why they're cutting, and that's probably why we'll get more cuts. Maybe they'll take a pause in December. I'm not so sure why it has to happen so quickly. I mean, the Fed usually cuts when there's an emergency or something negative going on. So for them to pause, that to me would be an indication that the economy is pretty resilient. Looks like it right now. So, you know, maybe we'll get a little pause and the jobs market is not so horrible. Interest rates ticked it up a bit today, but the trend is clearly down. We've got a little steepening of the curve, which is positive. U.S. debt levels and trade wars, these are concerns here. Again, looks like another cut after yesterday's cut, but again, not guaranteed. We shall see, you know, how this transpires. But to me, the trend here is down, and we'll probably get, if not a cut in December, the one after that. But I'm not sure the economy really needs it. Hopefully, we'll find out a little more employment data later this month. Sentiment, you know, not going to dwell on this too much. Bullish sentiment is elevated as it should be, near new all-time highs, with you know, year-to-date gains. Q4 tends to be bullish as well. It's high now. It can stay high for a while and for extended period of times, as you saw here. The last run stayed high for quite a while, up until we had the tariff tumble here. So we can probably go up a little bit higher, probably over into that 7,100 area that I've been mentioning. But, you know, sentiment jumped. I use the Investors Intelligence here. It's pretty reliable. It's well known, and it's been out there for a while. It jumped to 57.7% bulls from 52 a week ago. Bears fell to 13.5 from 15, the lowest amount of bears since 2018. Excuse me, one of the wider spreads since late July 24 over here. Late July 24, yeah. So again, sentiment is bullish as it should be. All right. Seasonality of Bitcoin. And what I've done here is finally we were able to get to a seasonal pattern for Bitcoin. A couple of years ago, I teamed up with Adrian Zdunchik, the crypto burb out of Poland. He's a CMT, big Almanac fan. And we put together a seasonality Bitcoin study, and with enough data to make it statistically significant. So we have here on the left scale, I've got the black line, which is all years going back to 2011, the first full year after the data became available. Most of the data out there starts in July 2010. And then the green line is since 2018, because that's the first full year after the CME futures began trading in late 2017. And you can see that the old, pattern was a bottom in late October. The more recent pattern, bottom in late September. We appear to be testing that bottom in September, making a double bottom here, potentially in October. But here is the Q4 rally. Pretty impressive. November, historically one of the strongest months for Bitcoin. And the early breakout had some hot new highs, but we failed on the sort of tariff October phobia fears. And, with us testing these lows here, I guess the numbers, the level that we're looking at is 105, 107. We were in that rare area today. We do have a recommendation in the newsletter for some ETF with buy limits in there. You can check that out. So we're watching 100,000 on Bitcoin. If we break below 95, might be looking at an exit, but there's a high correlation to speculative tech with Bitcoin, and this is that time of year for tech to take off. So technically, again, looks like we're finding some support here. This is the 200-day and then the 50-day in the pink line. So kind of messed with that pivot point support in the green dots. We're seeing a little MACD crossover here and a little stochastic uptick. So again, looks like we're testing that September low, potentially another buy the dip moment for Bitcoin. Ether, still sort of tracking Bitcoin's path, sort of behaving like its younger brother, kind of like gold and silver as well, testing its seasonal low around late September. Again, finding some support here, consolidating. And then the gold and silver, I know it's on everyone's mind these days. Looks like there's some profit taking here. We did have more new highs over 4,000. Silver making a new all-time high finally as well. But like gold, it's pulled back. We have a seasonal trade here that runs, towards the end of the year, but we think we might have seen all that seasonal run here. We're still holding GLD, but we did get out of the miners and the junior miners hit our auto sell levels for 20% gains for both over 2 months. So if you're in this, consider tightening up some stops or taking some profits into strength. As I said, I think the highs for this seasonal run could be in, but there's still a lot of central bank buying, there's still inflation, weak US dollar, so probably continue to support gold and silver over the long haul. Oil's something that everyone's on their radar as well. When is the energy going to participate? The usual seasonal summer strength, non-existent. We know that this administration wants lower prices. That's one of the best ways to reduce inflation. So can't blame them. And this pressure seems to be keeping a cap on the price. We see Russia oil still flowing, and likely a lot more than is known as attempts to keep funding its endeavors. Interestingly, according to Bloomberg, there are 1.4 billion barrels of crude on board tankers now. This is around a 2-week supply for global demand. So if crude does spike, those tankers will likely be heading into port, and the price will likely find its way back to where it started. This year's seasonal trade is something that we're concerned with. It might be a dud. It's coming around on the calendar soon. But on the brighter side, it might mean lower heating bills for many of us in the colder climates. So the year-end seasonal trading roundup. Right now, we've got this Halloween trade on, and then upcoming the trade in the Thanksgiving market. We've got some sector seasonal trades and undervalued stock picks, under the radar stock picks that are out there. Small caps. This is all featured in the Stock Traders Almanac, the 26 in the back of the book, towards the December section, Thanksgiving, November, December section. You can find all these trades. The small cap feast, Thanksgiving to Santa Claus Rally, to free lunch on Wall Street. This is an old school technique of what we call the only free lunch on Wall Street, where we buy stocks making new 52-week lows on the triple witching day before Christmas. We glean the list for liquidity and making sure that they're solid companies. These are tax loss selling dogs that tend to bounce. So it's a short-term trade that we feature in the newsletter, and it's also discussed in the Almanac. And then there's the small cap event, the old January effect, which often gets confused with our January barometer. The January effect was that small caps outperformed large caps in January. Most of that tends to occur in the last half of December. Unlike the January barometer, which Yale invented, which is as January goes for the S&P, so goes the year. And then there's the real Santa Claus Rally. This is an indicator, not a trade per se, and it's part of our January indicator trifecta, the first leg, followed by the first 5 days early warning system and the January barometer. So more on the Santa Claus Rally in a second, but here's the Halloween trade. Not too scared. Did come back a little bit today, so up 80% of the time for Dow, S&P, and NASDAQ, up 77% of the time for Russell. 2.5% gains over a 7-day trading period. This is the last 4 days of October, the first 3 of November. And as I did mention, there is also this bullish cluster for the S&P at the first 6 trading days of November are all up historically for S&P. So the Santa Claus Rally, 1972, the birth of the Santa Claus Rally, the January barometer. Back in 72, published in the 1973 Almanac, you can see here the extraordinary January barometer and the Santa Claus Rally were devised by Yale Hirsch. Santa Claus Rally is the last 5 trading days of the year and the first 2 of the new year. S&P averages about 1.3% gain since 1950. But the point is not this rally to get all excited about. It's to watch it as an indicator, because as my father stated back then, and his famous phrase is that if Santa Claus should fail to call, bears may come to Broad and Wall. And, I mentioned January barometer. As S&P goes, so goes the year. But when the Santa Claus Rally fails to call, we've seen flat years in 94, 05, and 2015. Some nasty bears in 2000 and 2008. A little mini bear in 2016, bottom on February 11th. We didn't get any bear in 24, but 25, we know what happened early this year. Yeah, Santa Claus was down, and we had a near bear market. Some people called it a bear market. I did not. But the tariff tumble, which was a steep correction, was perhaps telegraphed by Santa Claus failing to call on Wall Street. Here's the page from the current Almanac, page 118. You can see the whole history of it, but this is what is important to us. It's not a trade. Everyone's very hung up on it being a trade. Yes, year-end rallies are tradable. Bullish for the Q4 monster rally and higher numbers, but the Santa Claus rally is an indicator. And when it doesn't happen, it's an indication that because you have people, pros buying up stocks that are sold off and tax loss selling. So when the market doesn't rally during this period, it often foreshadows weaker performance or increased volatility in the new year and a chance to buy stocks at better prices. And I think we're going to have that chance next year. So just a little recap. Headwinds are coming from the Fed and tariffs, geopolitics as well, the Mideast, still some issues there, Russia and China. Inflation's rising. We shall see. Labor softening. We're all not sure yet. Doesn't seem to be that bad. Maybe a little cooling, as the Fed chair said. The shutdown, it'd be nice to get that wrapped up, and things are clearly a bit overbought. The tailwinds, all-time highs, the Q4 market magic, post-election year strength. Some rate cuts in the Fed, we'll see if we get another one. Economy seems pretty steady, calm in the Mideast, despite some of the rhetoric and ceasefire issues over there. Government spending is still robust, even though we're shut down. I'm still getting notifications from different governmental bodies in the mail, so somebody's working over there. Deregulation and tax cuts. So our outlook is that we've got a monster Q4 rally, S&P 7100, potentially one more quarter point cut this year, a steady economy, stable job market, 20% gain for the year, and the AI super boom rallies into early 26. So give you a couple of seasonal stock and sector ideas. We've got ETF recommendations with buy limits, stop losses, and targets for our ETFs correlated to these sectors that all come into play in October. These are the 10-year average gains over the period of time from October to when it ends. Again, StockTradersAlmanac.com, Almanac Investor Newsletter has specific picks for different ETFs and stocks. We tell you what to buy and when to buy and at what price and when to sell. Our stock portfolio is up 771% versus 384 for the S&P. You also get the annual book, the best 6 months buy and sell signals, our market calendar, the vital stats, market at a glance, pulse of the market, all of our strategies, the trades, and the undervalued off Wall Street trade, our stock picks. This is where we take the universe of stocks and run it through our fundamental screens, looking for stocks that are exhibiting an acceleration of growth in revenue and earnings, good valuations, PEs, price to sales ratios. We're looking for stocks that are making money and humming. We're looking for a little relative strength, humming under Wall Street's radar, just kind of buzzing along with the market, not beating it, not trailing it, and also that are underfollowed on Wall Street. So we look at how many analysts are following it, not what the analysts are saying. So when we find us two stocks, all things being equal, we pick the stock that is followed by maybe a handful of analysts, 3 or 4 or 5, versus one that's followed by 10 or 20. Reason being that once what we're seeing becomes realized, more analysts will jump on, more buy recommendations, and we look for things that are sort of not, that you're not reading on the screens out there. So also, most importantly, I'm going to take some questions here at the end, but when we do our monthly call for members only, like we did yesterday, we spend quite a lot of time taking questions, at least a half hour, if not 45 minutes to an hour, depending upon the day. So the newsletter is for fund managers, advisors, and individual investors. As I say, those who understand market history are bound to profit from it. I think we are the authority on seasonal market performance. We give you market seasonality and historical patterns in conjunction with fundamentals and technicals to make better trades and investments. These same patterns happen year in and year out. You need to know about them. We show you how to capitalize on them. And just a little highlight reel. Understanding market history can produce gains like these. Some of our technical sector ETF trades, and then a few stock picks, recent stock picks that have done quite well. Just a couple of highlights there. Here's the chart on our portfolio performance through the full year of 24. versus the S&P and Russell, 350 and 84 versus 771. So I will take some questions now, but if you'd like to join up, now is the time. You get a free copy of the Almanac, ready to ship out right now. Go to stocktradersalmanac.com. You can click on Get the Almanac for free. Use this QR code. Use this promo code to save some money. And then I will pop out the questions box and see what kind of questions I can answer for you guys. Let's see. JC says, can you please show the midterm year's performance with 26 midterms coming next year? Here, I'll show it to you in the Stock Traders Almanac on page 10. That's something you're going to have to come join us to see, but it is right here very quickly, if you can see that. You can give us a call, shoot us an email. Happy to send you more on that. Let's see. Thank you, CB. Appreciate that. And I don't know, are there any other questions or is, oh yeah, here we go. Bob Tucker's coming in. Let's see. It seems that the last few years, the rally peaks around 12.14 or 12.15 and sells off until January. Last few years is a few years. So, you know, I'm not convinced that that's a pattern, but usually we see some weakness in the beginning of December, and then we get a rally into, you know, first quarter next year. You know, Q1's okay. After that, it's different. But January, I will tell you, Bob, has been weaker over the years. It's still one of the top months, but we've seen some profit taking in January. Almanacs in digital format. Yes, it is available through particular digital carrier. It's not on Kindle, but if you send us a note, we can locate that for you if that's super important. Honestly, I've talked about this with people. It's really made to carry with you and to write stuff down in. It's okay to look at digitally, but it's a tactile thing. And, you know, I keep it this small so I can throw it in my laptop bag when I travel. So, oh, you're welcome, JC. Yes, we shipped the book to Canada. If so, would it be shipped within a couple of weeks? Yeah, we'll ship it within a week. It'll get out of here, probably sooner. That's for Damoon. Yes, we have lots of Canadian subscribers. 26 Outlook. You got to go read about it in the 26 Almanac, pages 10 and 11. I just flashed it, but we will put out a full forecast that third Thursday of December when we do our annual forecast. It will be the 18th this year. That's when the forecast issue will come out. I've teased about it a little bit out there. Thank you for the loving the printed book, CB. Let's see. Do you or other individual consultant, do you offer other individual consultant services? We can get your input. I'm open to that. Reach out to me. You can go through the website, give us a call. RL. I have consulted before on a case-by-case basis, so I appreciate that. So 4:59. Looks like we've come to the bottom of the questions. If there's another one or two, I'm happy to take it. Otherwise, we'll let everyone go. And remember, if you signed up for this, you'll get a, I think, are we going to send out a recording to people and the slide deck, Chris?
Yes, that's an affirmative. Yes.
Thank you.
They signed up, they'll get it. And we might even have the video out on the blog and YouTube too.
All right, cool. All right, everybody. Happy trails, happy trading. Don't worry about the October phobia. The rally is on, or will be on It's starting next week again. All right. Thanks, everybody. Have a great day.